Welcome back to Weekly. Joining me now for chat number one of the Weekly panel in 2020 is Brian DaCosta and Kevin Muir. It's great to be back, guys.
Great to be with you today.
Thanks for having us back.
So you guys both had great calls going into year end because in late November you said just be long. Now 2020 starts with a lot of optimism. And what was your take on how the world was shaping up for that first couple of weeks before the coronavirus hit?
So the way we were approaching the market, or I think about it, was the China-U.S. trade deal, or call it a trade truce, coupled with the Federal Reserve indicating they were going to let things run hot, meant that I thought the bull rally or the rally in risk assets would continue, mostly because I thought once you have a trade truce, the weak spot in the global economy was business investment, capital spending, and trade. And there would be a chance here for some of that to pick up. And so we thought, that you still needed to, despite valuations not being particularly inexpensive, that the rally still had room to run.
So in other words, credit spreads could still tighten, stocks could still go higher.
Correct.
Kevin?
Well, I completely agree, but I actually think that the Fed was the most important thing. When Powell shifted and showed that he was no longer going to go and tighten at the first sight of kind of inflation picking up, and that 2% was no longer going to be a ceiling, but a target, meaning that in the past, as it approached 2%, the Fed had gotten hawkish. Now they're saying because we've gone through a period when it's actually below 2%, we can afford to go through a period when it's above 3%. That was huge for the markets. Markets read that as time to relever, and you saw all sorts of large funds putting on reflation trades, going out and buying equities, buying emerging markets, buying commodities, and selling fixed income.
So now where do we sit here today with respect to your views, given the situation with coronavirus?
So the situation with the coronavirus is difficult because actually no one really knows much about the illness. What we do know is it's spreading. It's spreading faster than SARS did. The mortality rate is lower. And so that's why we're seeing the market pause. I wouldn't call it a significant retracement here because for the most part, people are probably leaning into it's a temporary phenomena. So we'll get a quarter. It delays the growth story by a quarter, let's say. But at the back of everyone's head, we've all seen the disaster movies on TV. There's always the what happens if this really persists or gets really worse. And I think that you're simply pausing here to wait. It's only the passage of time that can tell you what's going to happen.
Paradoxically, I actually think it's caused a bid in the U.S. stock market as investors have abandoned the EEM, like emerging markets, and gone into the safe haven asset, which is U.S. stocks. And so you've seen a monster bid into the U.S. stocks, and especially the Fangs, and you have things like the EEM down 6% this month. Meanwhile, the S&P is sitting up 2%.
Yeah, but it's basically all the Fang stocks. I mean, bank stocks are down, small cap stocks are down, cyclicals are down, except for the Fang stocks that are up.
You're right, and that's an interesting point in the fact that we're seeing the market get more and more narrow. And the question is, are we going to have a correction in those Fang stocks, or are we kind of on the point where these things are about to shoot to the moon? Let's face it, we just had Amazon's earnings. They were terrific. Apple's earnings were great. Microsoft's blew the doors off. There's nothing bad. It looks like these companies are just printing money, which is very different than in past cycles when we've seen kind of the crappiest stocks rallying because those are the most speculative. There's actually some really good companies that are making money that are causing the market to go higher.
So what's an investor supposed to do right now? Because you don't know if this coronavirus is going to become a big problem or not. What's an investor do?
So I would say for the most part, you want to, I would say, hold the course. However, if you're using leverage, I think this is a time you probably need to de-lever to a degree because you need you need financial flexibility back. I wouldn't be chasing the headlines. I think you need to be a little cautious around duration with the markets going in and pricing in further eases. That might take a bit of time. So I think for the most part, you don't want to do too much.
So in the last few days, there's been growing speculation that the Chinese government will bring on even more stimulus as a result of the coronavirus. Fed futures are now pricing in a 1/4 point cut this year. So I'm wondering whether or not, if the virus does not become a real big problem, then the market's a big, big buy.
Right, and there's a couple of sectors that you can look at in terms of if you want to play the fact that this is overhyped and it doesn't end up being as bad. You can look at the shippers. Things like Scorpio tankers are down almost 40%. Copper, which is the cornerstone of the electric kind of revolution, it's down 15%. And oil, like the XOP, which is the US ETF, is down 20%. The XEG is down 12%. All of those things were sold hard on kind of global economic weakness scares. And if it doesn't end up being as bad as the markets anticipate, I suspect that those will be the areas that bounce the hardest.
So your outlook for 2020 hasn't changed. You see accelerating growth. You see higher yields at the long end and hence a steepening yield curve. Is that still fair?
In fact, I would argue that given this problem in China, we could see a situation where China pumps more liquidity into the system and actually the response gets even greater and that we get more growth in the second half due to the virus.
So would you be buying now?
Well, you have to be careful because, as this accelerates, the price movements increase. So yes, I would be gingerly buying. I would be aware that I would be ready to buy even lower. But I would be looking at those names that have been really hit, like those three sectors.
If I was going to put 100 cents into the market, would you be buying, 2020, 2020, 2020 over the next couple of weeks, or how would you layer on the incremental exposure?
Something like that makes sense, and I would look in terms of the panic. If you get a situation where you get some really bad headlines and futures are locked limit down, and those are the kind of days when you get those times when there's truly blood in the streets that you want to be kind of...
So bottom line is you want to get even more cyclically biased coming out of this thing.
That's correct. Yes, that's correct.
Yeah, I would agree. I think the bounce back will be in the asset prices that were hit the hardest.
It's as simple as that, huh?
It's that simple. I think that the approach, though, I would take is slightly different than just time commitment. I would probably do it more off of market movement. So, if we've had a mild correction, I don't think this is where you call a dip to buy. But if you start to get to 5%, I think that's where you probably put in the 20% if you had $100 of fresh capital, and then 10% even more, and 15% the rest of it. So that's how I would play it.
Thanks very much, Brian.